welcome to Talking Money with Nosy, personal finance made simple. In today's video, I'm going to be talking about how much money you need to retire comfortably and 3 ways you can prepare for your retirement. This video applies to both those who are employed and those who are self-employed. Let's start with how much money you need to retire comfortably. Is 1 million rand enough, or is it 2 million or more? We will get to that. But what you need to understand is that the most important factor when it comes to how much money you need to retire is whether your investments are enough to pay you the income that you need to support your lifestyle after your retirement. Will a 2 million rand investment give you enough income when you're retired? Maybe, but maybe not. To calculate how much you need to retire, you need to estimate your expenses first. Let's say, just for the sake of simplicity, that you need 20,000 rand monthly income. 20,000 rand a month is 240,000 rand a year, right? The next step is to calculate how much you need in your investments to give you 240,000 rand annual income in your retirement. One option to calculate how much you need in investments is to use what is called the 4% rule. The 4% rule states that you should withdraw 4% from your investments every year. I'm going to leave a link in my description so that you can go ahead and read more about the 4% rule and how it came about. But basically, the 4% rule says that if a retired person withdraws 4% of their investments every year, those investments will last them for about 30 years. This means that for someone who needs 240,000 rand annual income, 240,000 rand should be 4% of your total investments. So I'm going to walk you through the 4% rule calculation. Let's use 20,000 rand monthly income, which is 240,000 rand annually, right? So what the 4% rule says, it says that your annual income, which is 240,000 rand, should be 4% of your total investments in the stock market, in your pension fund, etc. So this is the equation, right? If you remember maths, I'm taking you back to high school, guys. Total investments times 4% should be 240,000 rand. Obviously, you know how to do multiplication and division, right? So then we say total investments equals 240,000 rand divided by 4% gives you 6 million rand. So you need your total investments to be 6 million rand because 4% of that is 240,000 rand. Now you can do your own calculation. So to calculate how much your total investments should be, take your annual expenses and divide by 4%. You'll get your answer. The next part of my video is a conversation between me and a guy called Gabriel Botha. He has a website called finsesh.com where you can download really cool spreadsheets that will help you to calculate how much you need to retire, how long it will take you to reach financial independence based on how much you invest and save, of course. You can also download a budgeting spreadsheet, a debt repayment organizer, etc., and so much more. I'm going to leave the link to finsesh.com in my description. I highly recommend that you check it out.
Okay, great stuff. So we're just going to jump straight into it. Let me share the screen. So these tools are actually all within the course. And then within the course, the students are guided to use the tool in a certain way and to refer to this one. So when you go, for example, into the find number, it should give you an explanation.
Okay.
So just for future reference, this gives you an explanation of these images and then the example. How to use it. Let's dive into it. Let's start with that find number tool. I can show you so you can see everything, right?
Yes, I can see.
So this is the find number tool. The main idea with the logic behind this, it comes from the 4% rule. So you know the 4% rule, take 25 times your annual expenses. And that's what should be your investment amount account to be able to withdraw at 4% for the rest of your life, basically. So if you got monthly expenses of, let's say, 20,000 rand. So sorry, just let me say, all these tools, everywhere where it's blue, you can change. The rest, you can't change.
Okay.
Because it's formulas happening.
Okay.
So for example, let's say, for example, are you happy with 20,000 rand as a monthly expense?
Happy with that.
Then you can see it just takes it to annual. That's very easy. You just take the 20 times 12. And then that number gets multiplied by 25 to reach to 6 million, right? So what this tool does is it says, all right, now I've got 6 million Rand as a target. This is my fine number that I need to achieve in my investment account to be able to withdraw from it one day, right?
Yeah, to withdraw 4%, right?
Yes.
Yes.
Let's say, for example, you got a property. Let's say there's a street name, Oak Street. You have a property in Oak Street.
Okay.
And Oak Street provides a current net rental of 4,000 Rand.
Okay.
So in the red, when you hover it only, it will say net amounts only.
Okay.
Obviously, you want the net amount. So let's say it's earning a net income of 4,000 Rand. So it takes into account all your property and business income. And then it says your 20,000 Rand was what you needed per month as an expense. But now all of a sudden you only need 16,000 Rand, right?
Yeah.
And then it takes the 16,000 multiplies by 12 and it gives you a new amount. So now this person needs 4.8 million Rand in his investment account to fund the excess above the property, right? So the idea is that you've got multiple sources of income contributing to the same end goal. And at the end of the day, it just means you need to save less. So for example, let's say you've got another property earning 5,000 Rand. So now he's got a separate property that's 5,000 Rand. And then you can see it adjusts. Now he needs 11,000 Rand a month from investments. And all of a sudden he only needs 3.3 million in that account.
Okay.
And then the same applies when you change. So now you've got business income of another 4,000. All of a sudden, this client needs 7,000 Rand per month from his investments. Then it's only 2.1 million Rand. So as you can see, this tool just shows from multiple sources of income how you can reduce the amount that you need in the stock market.
I see. And then, so then it means the other tool, because this tool doesn't show how much you need to invest to reach your target. So do you have a tool that shows you how much you actually need to contribute to your investments to get there?
So let's have a look at this one. So this one is called the pie graph one. This one basically takes into account inflation. Let's say we take inflation at 6%, we're assuming equity returns of 12% in the long run. We start saving today, just let's say start of Feb 23.
Yeah.
Let's say you've got 100,000 Rand in your investment account currently.
Yeah.
So let's say let's use the same example. The client needs 20,000 Rand per month as monthly expenses.
Okay.
So now you can see that FIRE number is 6 million again.
Yes.
And as you can see, if the client's got 100,000 Rand, assuming those two inflation and equity returns, it will take him 40 years to reach his target.
Okay.
So you can see this graph on the right. It shows you. But now we can play around with it, with that monthly savings account.
Yeah.
Let's say we start saving 10,000 Rand a month.
Okay.
All of a sudden, now it's changed. In 23 years and 7 months, you will reach your 6 million.
This is absolutely cool.
So whatever amount you can play, let's say you got 400,000 Rand in your investment account currently. You can see the years keeps on changing. As you're playing around with the monthly savings and current investments amount.
Amazing. Just a quick disclaimer, guys, the 4% rule is a guideline that is used in retirement planning and it gives an estimate, not an exact figure. But anyway, whichever way you look at it, the amount of money that you need to retire is quite a lot, right? So how are you going to come up with all of that money? That's a big question, right? At the risk of sounding like a broken record, and I know some of you have given me a nickname because of this, you will get there with the help of compound interest, and the sooner you start investing, the better. If you invest a good percentage of your income and you invest regularly, you're going to reach your investment target.
This one is also quite relevant. So firstly, it starts with the static graph that just assumes family income of 80,000 Rand gross, right?
Yeah.
And the monthly expense is 60,000 Rand that I assumed for this couple. So quite pricey living. The top part basically just shows then for this couple, it's got the assumption of market returns on this x-axis.
So that's what at the top, that's market returns. Okay.
That's market returns. On the y-axis here on the left, it shows you the savings rate.
Okay, the percentage of the income that they're saving.
Yes. Okay. So you can see for this couple, let's say they're saving at 10%.
Yeah.
And we're assuming a market return of 12%. It would take them 22 years to reach by.
22 years. Okay.
Yeah. See, it works on that graph. So let's say, for example, they move up and all of a sudden they're saving 50%. Then it will take them 12 years. If you increase your savings rate, but then it decreases your amount of time to FI drastically.
Yeah, and this is relevant because one of the pushbacks that I get when I post on Facebook or whatever, when I talk about, I like to think about financial independence rather than retirement. And most people say, I don't want to wait until I'm 60. And what they don't understand is you don't have to wait until you're 60.
Exactly.
And if you don't want to wait until you're 60, increase your savings rate, which is the percentage
100%.
of your income that you're putting away. So when you put it like this on a graph, it makes so much sense. I love that.
This is a personal, not personal for me, but for the client can put in his personal amounts. So let's say, for example, you're earning an after-tax income of 30,000 Rand, and from the 30,000 Rand, you may be saving 10,000.
10,000, yeah.
So that means your discretionary savings rate is
33%, yeah.
Then what it does is, let's use that same example again. This client needs 20,000 Rand a month to have expenses. You can see that FI number goes to 6 million again. Then you can see here right at the bottom, assuming a growth level, it shows you how long it would take this guy to reach FI.
Oh, that's so clever. Oh my goodness.
Enter your personal things. Let's say your investment smacks out a stellar 13% per year. Then this actual client can achieve it within 14 years.
Oh, wow.
Then he says, no, okay, maybe 14 years is too long. I'm going to increase my savings to 15,000 Rand.
Which is 50% of his income, yeah.
Yeah. So there it adjusts, and there you can see now it's 11.7 years instead of the 14 it was previously.
Wow. And you built these calculations yourself?
Yeah. I've got a friend. He's like, I call him the god of Excel. So between the two of us, we get everything done, yes.
It's amazing. This is so cool. I know that my viewers are going to enjoy this.
This net worth one, I read it from a book, The Millionaire Next Door.
Oh, that's my favorite book. I love The Millionaire Next Door. Literally, that's the very book that changed my mindset about money. Before I read the book, I always thought it takes a special kind of person to invest or to achieve financial independence. And then the book actually tells you that people who achieve financial independence are normal people. So like teachers, mechanics. And I was like, what?
Exactly.
The survey shows that the different kinds of people that achieved financial independence are like in normal jobs. So your teachers, your doctors, your mechanics, like people who earn low and those who earn high as well. So that book gave me hope. I was like, okay, so I can do it as well.
It's like the people living in your neighborhood.
Yes.
You might even know. And what I liked about that book was that living flashy will never get you there.
Exactly. That's why it's called The Millionaire Next Door, because it's normal people. You can even bump into someone and you'll never know that they're a millionaire because they're so simple. They drive simple cars, they live in a simple house, and they're not flashy. That's the message that I'm trying to drill into people's heads, that look, it is dependent on your expenses, on your lifestyle. So you'll find that for one person, 6 million is enough. But if your expenses are 50,000, then 6 million is not enough.
Not enough.
It's not enough.
You need to up that by a lot more.
So 50,000, you actually need 15 million for FI. So I think people need to understand this. It's about your savings rate and your lifestyle expenses. That's the key.
No, 100%.
Next, let's talk about the 3 ways you can prepare for your retirement. The first and easiest way to prepare for your retirement is by contributing to a pension or provident fund if you are employed, and contributing to a retirement annuity if you are self-employed. Most people understand pensions and provident funds, but they don't understand retirement annuities. So let me explain what a retirement annuity is. A retirement annuity is a retirement fund that you can take out yourself as an individual. Retirement annuities are suitable for those who are self-employed, those that do not have retirement funds via an employer, for those who want to contribute extra for their retirement, or for those who earn extra income from side hustles parcels, interest income, or rental income from their properties. The biggest advantage of contributing to pension funds and retirement annuities is that this is one of the most tax-efficient ways of putting away money for retirement. The first tax advantage is that your contributions to these retirement funds are tax deductible, which means you pay less income tax. If you are an employee and you contribute to your employer's provident fund or pension fund, you receive your tax benefits upfront on a month-to-month basis because your taxes are reduced and your salary is automatically adjusted according to your pension fund contributions. But if you contribute to a retirement annuity personally, you are going to receive your tax rebates when you submit your tax returns during filing season. You can contribute as much money as you like to your pension fund and or your retirement annuity. There are no limits, and you are able to claim tax rebates for contributing any amount of money up to 27.5% of your taxable income, up to a limit of 350,000 Rand every year. If you contribute more than these limits, you are not penalized, but your tax rebates for those extra contributions are going to be rolled over to the following tax year. The second tax advantage is that all the income from dividends, interest, and capital gains that your pension fund and retirement annuity earns is 100% tax-free. Personally, I have a provident fund with my employer, and I also contribute to a retirement annuity myself, which I opened online with Signia. The second way to prepare for your retirement is by investing in a tax-free investing account, or TFSA for short. A TFSA is also a tax-efficient way to supplement your retirement contributions. But the difference between a TFSA and retirement funds is that you do not get tax rebates for contributing to a TFSA. This means that you contribute after-tax money into a TFSA, whereas you contribute pre-tax money to retirement funds. You can invest any amount of money into your TFSA up to a limit of 36,000 Rand per tax year and a maximum of 500,000 Rand over your lifetime. With a TFSA, you don't pay any tax on interest, there's no tax on South African dividends, and there is no tax on capital gains. You can also reinvest all of that income that you earn inside of your TFSA without incurring any tax. And guys, please note that there are different kinds of TFSAs. There are cash-based TFSAs, which are basically glorified savings accounts. I don't like those. There are also unit trust-based TFSAs, and there are stock market-based TFSAs, which allow you to invest your money into the stock market by buying ETFs. Personally, I use the stock market-based TFSA on Easy Equities, where I invest in local and international ETFs. The third way to prepare for your retirement is by having discretionary investments. Discretionary investments are investments that you have outside of your pensions, outside of RAs, and outside of TFSA accounts. And of course, these kinds of investments are going to attract tax, right? Because you are investing outside of tax-advantaged accounts. Personally, my discretionary investments are ETFs as well as shares on the American as well as the Australian stock markets. Your retirement is much, much closer than you think. And the sooner you start preparing, the better. We need to find a balance between spending our money on our current needs and wants, while at the same time making sure that we are preparing for our future as well. If you leave it until it's late, you might unfortunately not have enough money to retire on. I encourage you to take the time to understand the different ways of preparing for your retirement and how they match your needs. If you need help, I encourage you to contact an independent financial advisor. Don't leave things to chance. All right, guys, that's it for today's video. If you have any comments or questions about preparing for your retirement, please type them in the comment section below. Also, if you want to learn how to buy shares or ETFs for yourself, you can get copies of my ebooks. Please see the link to my online store in the description and comment section below. As always, please like this video and subscribe to my channel. I'm going to see you in the next video. Bye, guys.